Okay, so what we are going to cover today is Roth strategies uncovered. And why we're talking about this is that it's just really important to look at all of your different options when it comes to investing. And really looking at what we can control. So there's a lot that we can't control when it comes to investing. We can't control the markets. We can't control the government. We sometimes can't control our husbands and wives. I know I'm one of those. So focusing on what we can control, and that sometimes includes where we invest our funds and the taxes that we pay. So looking today at how can we be the most tax efficient and how can we look at having the best strategies employed. So what I want to first cover is some different definitions. So what is a Roth IRA? And think of a Roth IRA as a little bit of the opposite than a traditional IRA. So you pay the taxes now, and then they grow tax-free, as long as you follow some different rules and take out after age 59 and a half or the time frame, any withdrawals come out tax-free. So it's a great strategy to have put in place in addition to some of your other funds. And that's why we talk about the different types that we invest in. So we all know how important it is to diversify our types of investments, but it's also just as important to diversify the types of accounts that we invest in. And sometimes that gets not maybe done correctly, or something we think about maybe a little bit later. So we want to make sure we're getting that information to you right away and figuring out, is there anything that you should maybe do a little bit different? So what we will talk about today is the different types of accounts that you can have and maybe structuring income to come out a little bit different ways. So looking at the different types of accounts that there are is maybe you have like pension or land rent. 100% of that's taxable, right? We don't have any control. There's nothing we can structure differently with that. It's pretty dependable, which is great, but it also means that it's 100% taxable. Social Security is another income source that a lot of you have, and that the taxation on that is a calculation, and it's either 0 to 85% of that benefit that you received is subject to income tax. It's a calculation according to your other income sources. So when we talk about diversifying our types of accounts, that's really crucial when we look at how is Social Security taxed, because where you take your income from makes a difference. So the next one is the IRA. So everything that comes out of an IRA is 100% taxable. There are some different types of things that you can do from a charitable standpoint to make that not subject to tax, but otherwise any income that you take personally is 100% taxable. The Roth IRA, which we'll focus on today, is if done or taken out properly according to the rules, none of that is taxable when it's taken out because you've paid taxes on it previously. And then the last option is a non-IRA account. So this would be like a trust account, a joint account, an individual account, and that's taxed a little bit differently. So anywhere from 0 to 90% of that is taxable. And that's taxed a little bit more favorably, which is good, at capital gains rates. So depending upon where you are, that one's a little bit variable too of what that looks like. But there's a lot of different options of how you can take income and where you can take income. And this is another one of our controllables. So what we want to focus on is what's the best way for you to take income. And that's something that your advisor will go through and talk about with you is how should you structure and strategize where to take income from to be the most tax efficient. And that's something that we'll touch on an example a little bit down the road too. So in looking at this, kind of set like a stop and go light, right? Red is the most taxable. Yellow means maybe you have a little bit more flexibility, and green means don't have to pay taxes on that. So looking at the different types of accounts and how they're taxed is in structuring basically your traditional retirement accounts. The contributions go in, you didn't pay any taxes on those. You actually got that upfront tax benefit. They grow, which is fabulous. And that continues to grow as well. Maybe a little bit of that tax burden down the road, or like we call a little bit of a kind of a tax time bomb, right? You get into retirement, you have this great nest egg, but everything that comes out, you pay taxes on. The Roth, which you can see on that bottom part, is everything in there grows from a tax-free perspective. Gives you a little bit more flexibility down the road. The only thing that's not included on here that I will mention too would be like a health savings account, an HSA account. So if you're eligible, that's another great account type that we didn't see on the chart before that actually is triple tax benefit, triple tax advantaged. So anything from an HSA standpoint goes in and you don't pay taxes. It grows tax-free, and as long as it comes out and used for medical expenses, you don't pay taxes on that as well. So a great type of an account to utilize if you can and you're under that high deductible health plan. And if you're looking at, well, which one do I do first? If you can't do both, do the HSA first, but both is better. So today what we'll focus on is really diving into Roth accounts and how they can be helpful to you in retirement, and the unique ways to get money into a Roth account. So there's 3 different ways to get money into a Roth IRA. So we'll dive into those a little bit and really focus on that purple, kind of that Roth IRA bucket. So why are we talking about Roths today, right? What's so exciting about Roth IRAs? Well, there's 3 reasons why you would potentially want to look and say, does it make sense for me to put some money into a Roth IRA? One would be tax rates now versus later. So are you in a lower tax bracket than you will be later, or do you think tax rates are going to increase? That would be one reason. Another would be joint tax rates versus single tax rates. So what would that potentially look like? That's kind of another piece of, well, where do we think taxes are going and where do we think your taxes are going? And then 3 would be tax your children will pay. What will that look like down the road? So we'll dive into each of these. So starting with tax rates now versus later. So what this chart illustrates is the current tax brackets for 2022. And this chart specifically is married filing jointly, just for illustration purposes. So what we know right now is the tax rates for 2022. Something that's a little bit up in the air is what will happen 2026 and beyond. So that's when the Tax Cuts and Jobs Act is set to expire. And at that point, as far as we know, rates are set to increase or sunset back to what they were before that was put in place. So you can see on the second column, that would be where we would anticipate those rates to increase to. So, across the board, it's a pretty much an increase. It's just a matter of exactly where you fall in that. So something when we're looking at, should you try and get some funds into a Roth IRA, is where are you now and where do we think you'll be? And something that we have access to now and that we've really started to roll up is our tax analysis software. So what this is doing is helping us do some forecasting on, well, where are you now income wise? Where do we think things will look like? And I think this is going to be a really important conversation. It's often a big misconception that you're going to be in a much lower tax bracket in retirement. Oftentimes what I see is that people either are in the same tax bracket or potentially higher once you hit that age of 72 and you have to take money out of retirement accounts. So looking at, we know we're going to have to pay the taxes. Is it better to pay them right now at a potentially lower rate, or start paying them and getting them into a different type of bucket just to give you some more flexibility down the road, as well as potentially at a lower rate? So that's a key thing to take a peek at when we're looking at, should you get some money into Roth IRAs? It's so hard to know what's going to happen with taxes, but always trying to think ahead and be as proactive as possible is good from the long term. So looking at joint versus single rates, that's something that we want to consider too. And you're probably like, what, Amber, forget it, I'm married, right? I don't have any plans to change that. But realistically speaking, something that will happen to most families unless we pass away at the same time as our spouse is that most families at some point, one of us will file single. So something that we want to look at is, what will your income be at that point potentially down the road? For the most part, we'll still have our same land rent. Pensions will probably stay the same. The required minimum distribution, that will stay the same. So really, Social Security is the one piece that might go down a little bit. But for the most part, what we see across the board is that people stay within the same close to parameter from an income standpoint. But if you notice here, brackets change significantly. So let's say married filing jointly. Let's look at that top chart. And let's say your income was 83,000. You're very much, kind of just in the top of the 12% bracket. What happens married filing jointly, you're like, great, I'm filling up the 12% tax bracket, which is fabulous. We always love to see filling up that 12% tax bracket. What happens when you then cross into single at some point, potentially, that 83,000 is now towards the top of that 22% tax bracket. So that's almost doubling from a tax standpoint. So something we want to look at is that something that we should consider and plan for as well? Looking at, is there some opportunities now when we know where tax rates are and we know this will potentially shift later, is keeping that in mind. So kind of reiterating the 12% versus the 22% bracket. Something I will note too is it's often a misconception of, if you're in, say, the 22% tax bracket, that all of your income is taxed at 22%. That's not the case. It's actually a progressive tax system. So if you are in, let's say, the 22% tax bracket, you actually pay part taxes at 10%, another chunk at 12%, and only the amount that crosses over that bracket is taxed at 22%. So sometimes I have people say, should I not accept that raise because that's going to push me in the 22% tax bracket? I would say absolutely not. Take the raise, take any additional income potentially, but let's talk about it and see if that would warrant any changes. Because it's just the extra piece that crosses over. So, looking at, well, how can I maximize my brackets? That 12% is a really great bracket to maximize. So that's something that we always want to look at too. So talking about Social Security, I kind of alluded earlier that the taxation of Social Security is a little bit different. So 100% of what comes out of our retirement accounts is subject to income tax. Social Security is a little bit different, and anywhere from 0 to 85% of Social Security is subject to tax. So not 85% tax, get up off your chair, don't fall, but 85% of that subject to income tax. So something that we look at when we're looking at Roths and different things like that is maybe by restructuring how you take your income, you could save some significant tax. So if you are one who has land rent and some different things like that, you might not have quite as much flexibility to reduce the taxation on Social Security. But the more that you have in a Roth can really help reduce that too. So I want to walk through an example, and this is just a hypothetical example of a federal tax return. So not state, just looking at federal, of someone who's single. So let's say they have $500 of interest, $8,000 of dividends and capital gains that get paid, and they took out $5,000 from an IRA. So 100% of that subject to income tax, and they took out $25,000 of that from a Roth IRA. So remember, that's not subject to income tax. Have some Social Security income, like most people, which not all of that would be subject to income tax in their case. And that would put their gross income at $62,500. So their taxable income, when running that calculation, since the Roth IRA portion is actually received tax-free, their taxable income would be $7,200. So that's a nice chunk of income and ending up not paying a ton of tax. So let's look at what happens instead if the roles are kind of reversed. And instead of having that Roth IRA to take funds from, it all comes out of the IRA. So it's all subject to income tax. So same amount of dividends and interest, same amount of Social Security. But what happens is the calculation of income stays the same, but the taxable income increases significantly. And now it's over $50,000. So what happens is really the spendable portion of that goes down because they have to pay some income taxes on that. So by withdrawing more from an IRA or a pre-tax account, it's causing more of that Social Security to be taxed. So getting the same amount of income per se, but owing a lot more tax. And that's something that happens down the road that we try and always look at with clients too, is the more you take out of an IRA, the more Social Security gets taxed. It's kind of a little bit of an eye opener when you get your tax bill. And we like surprises, but tax surprises are my least favorite surprises. So always trying to look at that and say, how can we be the most efficient as we move forward? So looking at doing some of these different strategies or doing some different conversions and some things like that is a really great thing to look at before Social Security gets turned on to see what kind of opportunities do you have. Maybe you're one that's at the 85% anyways, and then it doesn't matter, but that's something that we can help look at and see what makes the most sense. And then the other piece or reason that you might want to look at taking advantage of getting some funds into Roth IRAs is just your tax rate versus your kid's tax rate. So if you're one of those that's been a great saver and you're like, I know my kids are going to get some sort of an inheritance because I can't spend all of my funds, even though I'll try, it might be something to look at too, of how can they most efficiently get an inheritance from you too, if that's a goal. So looking at the tax rates now versus later, something also to look at is what's your tax rate compared to what will your kids' tax rate be down the road. This is something that I'm going through with a client right now, is looking at doing some gifting. And they're like, really, my kids have done quite well, which is fabulous. But if something were to happen to me, so much of that's going to get eaten up in taxes. Because part of some different rules that changed a couple of years ago is they changed how non-spouses inherit retirement accounts. So now there's what's called a 10-year rule. So within 10 years, our retirement accounts need to be withdrawn from our kids. So when we look at, let's say you had $1 million IRA and you have 2 kids, that's a big chunk of money that has to come out every year. So depending on where their income is, adding, say, $50,000 every year could make a significant difference in their taxes too, and overall kind of erodes the inheritance or the gift down the road. So that's something also to look at too, if you're in that case of saying, if you're in, for example, the 22% bracket, which is a really big bracket, and we hope for a long, long time we don't have to think about it, but let's say down the road, your kids are even in that same bracket, that potentially shifts to 28%. That's a big difference. So it's your hard-earned money that you worked hard for and you want to, make sure goes to the right places. And I'm guessing the IRS isn't quite at the top of your list of where you want your inheritance to go. So that's another thing that is a good thing to bring up to your advisor if that is a concern or if something's important to you, but something that we kind of look at on the back end too. So we talked all about why it's important to potentially get money into a Roth IRA. Now I want to talk about the 3 unique ways to get money into a Roth IRA. So the first, and probably the most straightforward, would be making a Roth IRA contribution. There's some different rules around that, which we'll go through, some different parameters. The next would be a Roth 401k contribution. So that would be within your employer plan if that's an opportunity. And the third would be a Roth conversion. So this would be something that's open to everyone, regardless, where the other 2 are a little bit more restrictive on who can utilize those. So let's walk through the Roth IRA contribution. So what happens when you contribute to a Roth IRA is that you do not get a tax deduction. So you're putting in funds that you've already paid taxes on. So it's not a taxable event. Nothing happens or specifically needs to get reported. One of the restrictions is that you need to have earned income. So earned income would be from a job, something like that. A pension income doesn't count. Social Security doesn't count. It would need to be specifically earned income. And the annual contribution limit is $6,000 if you're under age 50, and it's $7,000 if you're over age 50. So in looking at having earned income, if your earned income was $2,000, that's the amount that you can put in. If your earned income was $100,000, then you're limited to the $6,000 or $7,000. So you need to at least have that amount in earned income. There's no restrictions on you need to have it for a certain amount of time for the year. So oftentimes I have people who maybe weren't eligible prior, but then they retire a couple days or maybe a couple weeks into January. That would give you the ability to make a Roth IRA contribution. So eligibility, that's one other thing to consider and look at if you can contribute to a Roth IRA, because there are some different restrictions. So what this chart does is it talks about the just IRA deductibility in general. So you'll notice there's kind of a lot of moving parts and there's a lot of things to think about. And the good news is that we think about these things for you. All you have to say is, what do you think? Should I or shouldn't I? And then we'll keep track of this. We keep up on these rules. But looking at this, kind of from the Roth IRA standpoint, it's the simplest, which is good, is that you don't have to look at, did I do this? Am I covered by this? Am I covered under a plan? The Roth IRA is basically just tied to your modified adjusted gross income. So if there is a point where you cannot contribute to a Roth IRA because you made too much money, and that would be these amounts. So if you made between $129,000 and $143,999 and you're single, that would be somewhere in there. You can make some sort of a contribution. It eventually phases out the higher you get. So if you made $144,000, then you're not eligible to make a Roth IRA contribution. The married filing jointly would be $204,000 to $213,999. So there is a point where you wouldn't be able to contribute. And note that this is adjusted gross income. So this is before the standard deduction or the itemized deduction. So if you're wondering if you can contribute, this is still kind of something that maybe you don't know or don't keep track of. We'll be able to let you know too if you're eligible for that. So that's something to keep in mind and make sure you ask about if you are thinking about making a Roth IRA contribution. So just kind of a quick summary of those. The other option is a Roth 401k to make a contribution into a Roth IRA. Similar is that there's no tax deduction. So you're paying the taxes and then you're making that contribution. So it's not a taxable event. Nothing specifically needs to get reported. Similar that you must have earned income, but the Roth 401k is a little bit different in that the annual contribution limit that you can put in is significantly higher. So if you'll remember, the other one was $6,000 if you're under age 50. This is actually $20,500 if you're under age 50 or $27,000 if you're over age 50. So much higher that you can get funds into a Roth IRA from that standpoint. And another really nice piece is that there are no income issues. So you could make any amount of money and you don't have kind of those phase outs that we just talked about. So it's a great way that if you are a higher earner and you have a Roth 401k within your plan, it's a great way to get some funds put into that space. This is something that we're starting to see added a lot more to plans. So if you're one that's working and you didn't have the Roth 401k before, something good to keep asking about, because maybe it's something they've added or something that they're considering adding if they get more people interested. So a great thing to utilize, especially if you're younger. If you're on the younger side, it's a great way to get some more of time on your side to have that continue to grow tax-free. And then the other option is what's called a Roth conversion. So what's a Roth conversion? That is moving money that you currently have saved in an IRA to a Roth IRA. So you're like, well, that probably sounds pretty good. So there are some different things to consider. Is that you don't get a tax deduction for doing that, of course, because you're making that, getting the funds into the Roth. But the thing to consider is that it is a taxable event. So what that means is that any amount you convert, you have to pay taxes on in the year that you do it. So let's say you convert $20,000 from your IRA to your Roth IRA. That would mean you'd report basically $20,000 on your tax return that you'd have to pay taxes on. So it's something that warrants a little bit more looking at some of the different numbers to see if it applies, but I have a lot of people that it makes complete sense. So could be something worth looking into if you haven't looked into that a little bit more. You do not need any earned income like you would to make a contribution. So this is something that applies to everyone because there's no phase outs or anything like that either. So if you're retired, you don't have income, you would be a great candidate for doing a Roth conversion too. There's no minimum or maximum amount that you may convert. It's kind of completely up to you to decide what makes the most sense. Something that we like to do is tag in your CPA or your accountant and help them determine too of what makes the most sense for you. What is that amount to maximize the brackets and always get their blessing. And that's why we love having a great relationship with CPAs just to help make some of these decisions for you too. So from an eligibility standpoint, like I mentioned, income may be whatever. You have the ability to convert as much tax as you're willing to pay, essentially. Something that, looking at, like I'd mentioned earlier, potentially kids inheriting, Roth IRAs are a great asset to inherit. They still have that 10-year rule that the account has to be withdrawn within 10 years, but it's a great account to let sit for 10 full years, get more tax-free growth, and then withdraw at the end of that 10th year and you don't pay any taxes. So it's a really efficient way to, if you're in a lower rate than your kids will be later. So we went over the 3 different reasons of why you might want to get some funds into a Roth, of tax rates now versus later. What do you think is going to happen with tax rates? Are you optimistic or are you more pessimistic? As well as, are you in a lower tax bracket now? Are you maybe just retired and you haven't turned on Social Security? It could be a great place to potentially look at that, as well as joint tax rates versus single. Are you one of those that income's not really going to change? Could be something, that might make a lot of sense, as well as tax your children will pay. Will they be in a significantly higher tax bracket, or do you just want to maximize the amount of a benefit that they get so that they don't have to pay a big amount of taxes? A few other things that I didn't specifically mention, but it would make sense to mention now is a couple other reasons too to potentially convert or get some funds into a Roth IRA is that if you're on Medicare, when you're on Medicare later on, the amount of income you take from your retirement account, so those traditional IRAs, that affects potentially your Medicare premiums. So the higher your income is, the higher your Medicare premiums go. So what's great about a Roth IRA is that any dollars that come out of there do not get calculated into your Medicare premiums. So that's another great way of, especially if you're teetering on crossing over that next threshold, being able to say, I'm going to take X from my IRA and X from my Roth IRA every year, and figuring out what works best there can end up saving you a bunch of tax down the road. Another reason too is that if you're retiring early before Medicare and you want to potentially look at the lower cost health insurance, some of those different options, you need to keep income down. And that can be hard if you have that big chunk in pre-tax, because then everything comes out, gets calculated as income. So if you're in that case too, and you know that you're going to be potentially looking at that from a healthcare standpoint, could make sense to get some more funds there so that you can utilize those in those years and get you up until Medicare. So some really good things to think about, just as you kind of continue to create your plan and look at things from a long-term perspective. If you haven't already, something that's really good to get your advisor is your tax return before you get together, because that allows us to put that tax return analysis together. So then we have some really great stuff to go over, basically all of these strategies, and say what makes sense for you and make that educated decision. So since I have a little bit of time, I do have one bonus I want to go over. And that is, well, what if my income is too high for a Roth contribution, but I really want to get some funds into a Roth IRA? And there is an option for you, which is great. So it's called a Backdoor Roth IRA contribution. So it's a little bit different of a strategy and it takes a little bit more planning. And this is definitely something you would not want to do on your own, that you'd want to tag your advisor in to help you. Is how it works is first you make a non-deductible IRA contribution. So you're putting the funds into an IRA, but you're not taking a tax deduction for those. And then what you're doing is you're turning around and immediately converting to a Roth IRA. So in the perfect scenario, which is why we like to do this together, it does not generate any taxes, but there are cases where it could, and that's called the Pro-Rata Rule. So where this can cause issues is if you have funds in a pre-tax IRA. So not a retirement plan at work, but an IRA. So maybe you had an old employer plan and you rolled that over, or maybe you have an IRA that you started many, many moons ago and it's just kind of sitting there. Any funds outside of that retirement plan then would affect how this strategy works. So what would happen is, let's say you have some IRAs worth $94,000 and you make that non-deductible contribution of $6,000 and then convert it to a Roth IRA. What happens is that pro-rata rule looks at all of those different IRA accounts and says, oh, now you actually caused some of that to be subject to taxation. So you would have to report $5,640 as taxes. So would not be something you'd want to do if you were someone who had IRAs, but if you're someone who's saved only within your 401k, and maybe you have like a joint account or an individual account somewhere else, the backdoor Roth could be a really great strategy to work on getting some of those funds in there. So that's something worth looking at too, if you're in that case. And, really just as a quick summary too of looking at all of your different buckets of funds, the sooner the better. And, I think this is something that's especially important as we look at, we can't control a lot. We can't control the markets. We can control how we react, and we can control where we take income. And, especially the more we look at this, the more being strategic in where we take income can make a really big difference in your long-term success. So that's why we're here to help, is we want you to be successful. We love hearing about all the good stuff you do. And the more tax efficient we can be, the more flexibility it gives you, which is fabulous. And, I know that it's a little bit of information overload. So, definitely feel free to rewatch this recording if there's anything that you maybe missed, anything in there that you're thinking of. Gosh, my friend Tammy could definitely take advantage of this. We were just talking about this the other day. Feel free to send them over the link too, and happy to help answer any questions that pop up. And just know that we're here to help and ultimately try and save you some taxes, trying to help you, live your best life.